Welcome to Football and Finance, Winning the Wealth Game, the podcast where football strategy meets financial success. Hosted by Max Wiltz, former college football player, seasoned coach, and CEO of River Rock Financial Group. This show dives deep into the winning mindset needed to dominate both on the field and in your financial life. Each episode, Max combines his passion for football with his expertise in life insurance, annuities, and wealth-building strategies. Whether you're an athlete, a business owner, or simply looking to improve your financial game plan, this podcast is your paycheck for achieving long-term success. Get ready to learn from the best, because here, we're not just playing for the win, we're building a legacy. Let's kick off your financial future today.
Hey, what's going on, everybody? It's Max from Finance and Football, powered by River Rock Financial Group. And today, the strategy is tax-free accumulation and transfer. So before I start the presentation, go ahead and like, subscribe at YouTube, Instagram, TikTok, and on Facebook. So my name is Max, and this is Football and Finance. So without further ado, let's go ahead and get started while I queue up the presentation. All right, so what we want to do in this particular presentation is, hopefully I don't bore you, but one of the key things about the strategy of generational wealth is accumulation and transfer. So accumulate, to build up, to add to is the first part. The second part is to transfer. In this particular presentation, I'm going to deal mainly with accumulation, all right, and vehicles of accumulation. I got to get my words right. Get a little tongue-tied. Okay, so without any pause, our goal at River Rock Financial Group is to create and sustain generational wealth, to educate people on the creation and the sustaining of generational wealth, to have strategic financial future plans, and to protect those assets and also have those assets accumulate. All right, it's a lot more that I can do in this particular presentation, but trust me, it's worth it. So without further ado, I've said that 3 times. Without going any further, let me go ahead and cover myself. All examples are for illustrative purposes only, not representative of any particular investment or offer of insurance coverage or benefits. Excuse me, by definition, life insurance cannot be called an investment. So there's that. Values shown are before tax. All withdrawals from a retirement plan are taxable as ordinary income. Please consult your tax expert and or advisor. Most life insurance policies, the beneficiaries or the death benefits are tax-free. All right, so what is the big secret? Tax-free accumulation and transfer to generate enormous passive wealth. For example, if there's a family of 5, father has a life insurance policy, the mother has a life insurance policy, they have life insurance policies on their 3 children, then guess what? Excuse me. Those benefits are going to continue to roll over, and those rolled over assets, those cash, either cash value or term policy benefits, when they pay out, can be used to do other things, can be used to invest, purchase other assets, etc. So right off the bat, you can see where life insurance benefits can be used, A, as an asset, and B, to purchase other assets by family members. This is something you have to plan for. It's not really a secret. It's more like, am I disappearing? It's not really a secret. It's more like knowledge, education, and understanding. PowerPoint has a mind of its own right now. So we like to purchase things that have little to no value. I keep disappearing off my inset screen. Cars, motorcycles, boats, RVs, jewelry, some of this stuff. Most of it, most of these things are what's known as depreciating assets, or I'm sorry, depreciating liabilities. There is no value in a depreciating liability. It doesn't matter how good it looks. Now, there are some vehicles that actually gain value over time. However, those vehicles, well, it's a touchy subject because some people are really emotionally attached to they're emotionally attached to their vehicles, excuse me, or their RVs or what have you. But most of the things you see on the screen are depreciating liabilities. On top of that, you're paying taxes to just have it. Once you pay it off, a car, RV, a boat, a motorcycle, you're paying taxes to just drive it at that point, right? So it's not really benefiting you unless you create a business to rent it out, then it may be a benefit. And then, of course, our consumable things, stuff, to look good, to smell good, to feel good, coffee, shoes, cruises, clubs, concerts, uh, vacations, streaming services, you name it, we buy it, right? People spend $300 to $500 a month on going out to eat. Bags, $500, $1,000, $2,000, $3,000, $10,000. Now, if you can spend $10,000 on a bag, well, or on a designer bag, you definitely need to purchase insurance from somebody. Oh, and let me back up. And on top of that, you're paying taxes to purchase the things that you like to consume. Most people don't have life insurance for these 6 reasons: expense, thoughts of death. I have a policy with my employer. I'm in great health. I'm in bad health. Lack of knowledge, or they don't trust. It's too expensive to not have life insurance. Term policies are low cost. Carriers have flexible plans. It's too expensive to not have. The tough conversation about death, passing on, passing away, things of this nature. Life insurance is about life, not death. Okay. Rich and wealthy people understand this, especially old money. Old money has been using insurance since their money was old. So they continue to do it, and the most people still don't get it. It's not about death, it's about putting the family in a better position in the future. Your employer policy is not your policy. It's common knowledge that several large employers have insurance on their employees. But if you don't have your own personal policy, at least get $50,000 of personal life insurance on yourself. If you have great health, good. You need to capitalize on that, and you have a wide variety of options. Term policies with return of premium, whole life policies with cash value accumulation, index universal life policies with the ability to participate in market appreciation, and a component to have cash value accumulation and have a death benefit for your beneficiaries and have living benefits. You're more seasoned. Final expense policies, term policies. So annuities, there's no real excuse to not do this. The thing I want you to think about is, let me go back. Everything in this picture has, most of the things here are have mandatory insurance, but we don't have mandatory life insurance. Lack of knowledge. Ask questions. Ask questions. There are hundreds of insurance carriers that offer dozens of different ways to benefit now in the future and in the future with life insurance. Not trusting family, I get it. Some people can't trust that. Not trusting carriers or agents or agencies, that's still an excuse. You can the insurance industry is heavily regulated, and we're bound to answer questions. Everything is in black and white. Everything is there for you to look and see and read and understand and ask questions. So let me get to the bulk of this particular presentation. Oh, see my face. What is accumulation? It is the principle that you pay into, if it's a whole life policy or a cash value policy or a IUL, it is the money that you pay into, or like, let's reverse it. If you borrow money to purchase a house or a car, it's the original sum of money, 10,000, 100,000. I'm sorry, 10, 5, whatever you're borrowing, right? 100, 200, $300 million, whatever you're borrowing. It's before the interest is added to the money for borrowing that money. So when you borrow money, the principal, the initial part is the principal. What is the interest? Simply put, it is the money that you pay back to borrow the money. And most people know it as a percentage of money, right? Now, I'm not going to get into simple interest and compound interest and things of that nature. It is the charge to borrow. So, in essence, this whole presentation is about you accumulating and transferring or accumulating wealth via using life insurance. You become the bank. When you give your money to an insurance company for a policy or policies or an annuity, they pay you interest. Now, I'm not going to get into this in this particular presentation, but no, an annuity is not a savings account. Life insurance policies are not savings accounts. All right. So let's kill that conversation. Principal plus interest equals accumulation. Now, when you deposit money into a bank, the bank takes your money and they lend it out. All right. You deposit money in a bank, the bank takes your money and everybody else's money, and they create loans. Now, not going to go into how they create loans. Right. The bank then turns around, if you have a interest-bearing account or a savings account, they pay you some interest. Now, here's what I want you to think about. If the bank is paying you 1 or 2% interest on your money, how much money do you think they're making in interest payments? Something to think about, okay? Let me move my face on the presentation. So here again, the bank is taking your money and everybody else's money in the grand scheme and lending it. They're making loans with your money. Now, if you don't have a savings account, you're not receiving any interest on the money that they're loaning that you deposited into the bank. Some people will argue me on my next point. When you have a life insurance policy, the insurance carrier pays you interest on your money. Unless you have a term policy. Term policies do not accrue interest. However, If you combine a term policy with, let's say, for example, an annuity, the annuity then gains interest. If you have a whole life policy, you can borrow money from yourself. Now, there was a young person, a young gentleman, individual who wanted to be contrary to my point. He said, it's not your money. Well, because when you borrow from a life insurance policy, something blah, blah, blah. Here's the proof. Here's the truth. If you have $1 million life insurance policy and you pay your premiums for 10 years and you borrow money from yourself and you continue to pay the premiums, you still have the life insurance policy. You don't lose anything by borrowing from yourself. Here's the catch. You don't owe the bank. When you borrow from the bank, you owe them. If you don't pay it back, then guess what? They do something to you. That's my point. People who say, oh, cash value policies are a ripoff, or permanent life insurance policies are a ripoff. What they want to do is sell you cheap term policies. Not cheap in the value, but cheap in premium. It's easier a lot of times to get a term policy because whole life policies cover you for your whole life. And of course, just like anybody, a carrier is going to do a little bit more due diligence on the client. Back to my point. When you get a whole life policy, an IUL, a universal life policy, an index universal life, I probably need to do a presentation on index universal life versus universal life. Okay. You are able to, in the future, borrow against your policy. I don't see the problem. The problem lies in preference, not in if it's a ripoff. It's not a ripoff because it has a benefit, a death benefit attached to it. So let me stop there. You become the bank because the carrier is paying you guaranteed interest. The rates do not fluctuate. Now, I don't know. Are there extenuating circumstances that may call for the insurance carrier to change the interest rate that you've locked in? Probably not. It would take probably some cataclysmic event for that to happen. So you become your own bank. And infinite banking, which is another topic, is not necessarily a problem. It's a name that they gave it. What we need to do is stop getting mad about people naming certain things. Okay. A word about savings. Everybody probably should have a savings account. However, savings accounts do not outpace inflation. It's been proven. Okay. So what you need to have is a strategy, like in football, to cover most, if not all, of your bases. Savings account, investment account, like stocks, bonds, if you can, life insurance, annuity, if you got 401k, cool. If you don't have it, cool. If you have a 401 product or a 401, 403, 4 whatever, all these things should be part of your strategy. Life insurance is just is the most unused way, I should say. And that's a good topic for another presentation. Life insurance is the most unused financial strategy amongst most people because they can't taste it, touch it, smell it, or they can't put it on, or they can't drive it. Savings accounts cannot outpace inflation. This has been proven. All right, so what are some of the instruments of accumulation? I've touched on some of them already and in multiple videos. Whole life. Okay, whole life has 3 names now. We've given whole life 3 names. Whole life, permanent life, cash value, whatever. The difference, whole life is for your whole, it'll go until you go, right? It's going to go when you pass away, your beneficiaries are going to receive the face amount. If it's 100,000, 200,000, 500,000, $300, $600, $1 million, $10 million, whatever, your beneficiaries are going to receive that amount tax-free. Okay, because it's accumulated value. It is accumulated interest. Okay. Annuities. No medical exam. You can put a lot of money into annuities and accumulate the money tax-free inside of an annuity. Now, you have to be strategic when you start taking regular income payments from annuities, because that's what happens. Right? Required mandatory distributions. I'm not going to get into that, but that's what they are. Excuse me. And then index universal life, IULs. They have 3 components: whole life policy, and a death benefit, and I don't want to use the word, the I word, but it basically allows you to participate in the financial markets. And then trust, which I'm not going to get into in this particular presentation in depth, but trust are vehicles that you can put these instruments of accumulation inside of to allow yourself and your beneficiaries to benefit off of the tax-free accumulation really forever. And here is the bottom line. This is what rich and wealthy people have been doing for a long time. I don't have a problem with rich and wealthy people. Okay. I don't have a problem. And you shouldn't either. What you should do is figure out how to benefit from the same strategies. Whole life insurance, permanent life insurance, cash value is built in. You can borrow from it while you're still alive, and have a death benefit for your beneficiaries. And you can possibly have living benefits attached to it. Guaranteed interest. IULs. So let me hang on just for a second. The IUL combines a traditional universal life insurance with the potential cash value growth linked to the performance of a stock market index like the S&P 500. Now, I'm not going to get into stocks right here. If the index performs well, your cash value increases. If the index performs poorly, there's a minimum guaranteed interest rate to prevent a loss, usually. Have a illustration run if you want to know more about this particular policy type. What are you going to do in the future? What is your duty to your family? What do you value? What's going to happen in the next 10, 20, 30, 40, 50 years? What do you value? How are you going to outpace inflation? What are your goals for retirement, your kids' education? Do you believe in delayed gratification? What will your family do when you're not here? Not if, but when. You have an obligation. Everybody in the family should have a life insurance policy. Plan for what's difficult while it's easy. Do it now. Don't wait. Okay, so once again, ladies and gentlemen, people, good folks, my name is Max. River Rock Financial Group is an agency. We are licensed in the Peach State, North Carolina, and the Lone Star State. You can find us on Instagram, TikTok, Facebook, and YouTube. And just like in football, you need to have a strategy for your finances. And until next time, thank you so much. Tune in again.
Thanks for listening to Football and Finance, Winning the Wealth Game, powered by River Rock Financial Group. Remember, every great play starts with a solid plan. Until next time, let's keep winning on and off the field.